Right, look at this 2013 MCQ paper. The first question, which one of the following is a normative statement? So this is something that we have discussed in our previous papers as well. So if it's a normative statement, this statement should answer to the question of what should happen or what should exist. If not, in other words, this normative statement has to be someone's opinion, someone's belief. So out of the 5 given options, we will try to recognize this opinion or the belief. If not, we will try to recognize the statement which answers to the question of what should happen or what should exist in the society. Right. The first one, economies classify natural resources as renewable and non-renewable resources. This we can recognize as a fact. We can check whether this given statement is true or false easily. We can check it easily. If so, such statements we recognize as positive statements, not as normative statements. The second statement, the environment is an example for a scarce resource. See, the statement could be right or wrong, it doesn't matter. If it's a fact, that is once again a positive statement. And the third one, economies have limited means to satisfy unlimited wants. So once again, this is a fact, so that we can recognize that to be a positive statement again. The fourth one, the rate of inflation in Sri Lanka at present is single digit. So this could be again right or wrong, we don't know. But we can easily check the accuracy of this given thing. And this is once again a fact. If not, in other words, this statement answers to the question of what is the inflation rate, what happens, what happened, or what will happen. This statement answers to one of these 3 questions, so that we can recognize that to be a positive statement. But look at the fifth one. The fifth option says an unequal distribution of income is unfair, is someone's opinion, someone's belief. So that we recognize this to be that normative statement that we were looking for. So the answer for this question 1 is the fifth one. Second question, the opportunity cost of increasing capital investment in a fully employed economy would be. Okay, so these are the things that we need to understand here. The economy is trying to increase the amount of resources that they have allocated to produce capital goods. So they employ more and more resources to produce capital goods. And the other point that we need to keep in mind is this is a fully employed economy. I mean, right now the economy is operating at a point on the PPC. So if so, this is what we need to assume. We need to assume that this economy produces these 2 goods. On this side, let's say we have capital goods, and on the other side, let's say we get consumer goods, right? Consumer goods. And right now, since the economy has achieved this full employment, we can assume that this economy to operate at a point on the PPC. So what happens now? The requirement is to recognize the opportunity cost of increasing capital investment in a fully employed economy. So what happens? You are allocating more the available resources to produce capital goods, and the requirement is to recognize its opportunity cost. So we know what happens if this economy moves from point A to point B. Yes, we all see that they can increase the production of capital goods. So they can increase the production of capital goods. But as a result, what happens to the production of consumer goods? That decreases, right? That decreases, which means the amount of, let me write it here, the amount of consumer goods, get decreased, and as a result, the current standard of living also decreases, right? So this is the outcome. If not, this is the opportunity cost of increasing the amount of capital goods. Your whatever the available amount that's there to produce consumer goods that get decreased, and even the current standard of living decreases. So that's the opportunity cost, and we'll try to recognize that answer. The first one, a fall in consumption, and the second one, a fall in income. No, nothing happens to the level of income, and a rise in savings. Once again, that's not what happens. A rise in the rate of interest, no. And the fifth one, fall in output, no. The simplest answer is what happens, the amount of consumer goods get decreased, so our consumption reduces. So that's the answer for this question number 2. Right, now look at this question number 3. It says the term transition economy is used to describe a country. Okay, so this is very straightforward. So how do we, what are the economies that we label as transition economies? Those are the economies that are in the process of transferring from one economic system to another economic system. But what happens normally in real life, when I say that the economic system get transformed from one type to another type, in real life, this is what happens. The command economic systems, right? The command economic systems get transformed into free market economic systems. So the term transition economies we use to recognize the economies that are in the process of transforming from a command economic system to a free market economic system. So let's try to recognize that answer. The term transition economy is used to describe a country that is adopting capital intensive methods in place of labor intensive, no. Moving from central planning towards the market economic system, 100% correct. So central planning simply means the command economic systems. So they are now moving from their central planning mechanism to free market economic system. So answer for this question 3 is the second one. But we will go through the other options as well. Moving from low income category to middle income, no. Replacing a trade deficit with a trade surplus, no, they don't have meanings actually. We don't have a meaning to describe. That is the problem. The fifth one, moving from a traditional economy towards central planning economy, no. So what happens in real life, all these command economic systems get transformed into free market economic systems, and we use these transition economies to recognize such economics. Right, look at the fourth one. One of the important characteristics of a centrally planned economic system is, all right, so what are the qualities or the characteristics of these centrally planned economic systems? Right, we will quickly go through one by one. The allocation of resources based on relative prices. No, if it's a centrally planned economic system, if not in simple terms, if it's a command economic system, right? If it's a command economic system, we don't have any function for price. We do not use price as a guiding device. We don't use price to allocate resources in a command economic system. No, answer is wrong. The second one, the private ownership of resources, which is fundamental to economic growth. Okay, it could be true. I mean, the private ownership of resources could be a fundamental requirement for having a higher economic growth. But the problem, this is not a quality in command economic system. If it's a command economic system, the resources, if not in general, the properties are owned by the public sector, not by the private sector. The third one, the decisions taken by government planners regarding how best to produce goods and services in the economy. Of course, if it's a centrally planned economic system, the government planners, if not the central planning authority, makes the decisions with regard to basic economic problems. So this CPA, the Central Planning Authority, will decide what to produce in what quantity, how to produce, and also even they will decide whom to produce. So this is one of the main qualities we see in a centrally planned economic system. So the answer for this question 4 is the third one. But let's go through the other two options. The achievement of economic efficiency superior to the market economic system. No, it's the other way. Economic efficiency, the probability of achieving this economic efficiency is very high in a free market economic system compared to centrally planned economic system. So it's the opposite. The fifth one, very unequal distribution of income and wealth. No, this unequal distribution of income, if not, theoretically we say a disparity in the income distribution is visible in market economic systems, not in centrally planned economic systems. So once again, the opposite is true. Right. So that's the answer. I mean, the third one is the answer for question number 4. Right. Now look at this fifth one. It says the diagram shows the market demand and supply curves for a product. Okay, so we see the market demand and also we have the market supply. Then by giving this diagram, they ask us to recognize which area measures the total amount consumers would be willing to pay for the equilibrium level of output. All right, so let me just show you these 2 points. This is the intersect, right? This is the intersect of the 2 curves. So we recognize this point A to be the equilibrium point. If not, this is the point at which the expectations of suppliers and the expectations of buyers become equal in this market. And hence, this price we recognize as the equilibrium price and this quantity we recognize as the equilibrium quantity. Right. Let me just put some values to these points. Let me just tell you that the equilibrium quantity is 1000 and the equilibrium price is rupees 150. So what if I ask a question? If this consumer is going to purchase this very first unit in the market, right? If the consumer is going to purchase this very first unit in the market, let me ask this question. What's the amount that this consumer is willing to pay for that quantity, for this very first unit? That is shown, that is presented by this demand curve. To purchase this very first unit, the consumer is willing, the consumer is ready to pay a price of this much. And to purchase this second quantity or the second unit in the market, the consumer is ready to pay a price of this much. See, this gap from this point to this point, again this gap from this point to this point, again this gap from this point to this point, right? Those gaps show you the amount that these consumers are willing to pay for each unit that they are trying to purchase. If the equilibrium quantity is just 1000 units, then this total area from unit 1 to, right, the total area from unit 1 to, right, the total area from unit 1 to this 1000 unit, this entire region will show you the total amount that these consumers are ready to spend to purchase this quantity. So that is this entire shaded part. So what's the answer then? The region presented by O, Q, E, K. O, Q, no, this is not the answer. Yeah, look at this one. O, K, E, Q, it's anyway the same region, right? So the answer for this question 5 is a fifth one. හැබැයි මම ඔයාලා තව දෙයක් දැන් ඔයාලට මේක පැටලෙනවද දන්නෙත් නැහැ කියලා හිතලා මම මෙහෙම දෙයක් කියන්නම්. මොකද්ද? Now for example, if you just focus on this, let's say this is this 25th unit. To purchase this 25th unit, the consumer is willing to pay this much, right? That is the price presented by the demand curve. That's the maximum demand price anyway. To purchase this 25th unit, the consumer is ready to pay a price of this much. But thanks to this market equilibrium, he needs to pay only a price of P. Then if I ask this question, what's this difference between this point and this point? What's this vertical gap? That you recognize as a consumer surplus for this 25th unit. එතකොට මේකේ දැන් දේවල් දෙකක් තියෙනවා. මොකද්ද? To purchase the equilibrium level of output, the consumer has to pay only a price of P thanks to the market equilibrium. But the question doesn't ask us to find the amount that the consumer has to pay. The question is asking us to find something else. මොකද්ද? මේ දෙකේ වෙනස ඔයාලට පේනවද කියලා මට කියන්න. මොකද්ද? දැන් මම කිව්වේ what is this price P? That is the price that consumer has to pay for each unit if he is purchasing a quantity of Q, right? So this is the amount that the consumer has to pay. But the question doesn't ask us to recognize the amount that this consumer has to pay. The question asks us to recognize the amount that the consumers are willing to pay. So they are willing to pay for this. For example, if I select this 25th unit again, for this 25th unit, they are willing to pay this much, right? They are willing to pay this much. But this is the amount that they really pay. Since the question is asking us to recognize the amount that they are willing to pay, it has to be this entire region covered by the demand curve up to the equilibrium quantity. And that's why this becomes the answer. The amount that they are willing to pay and the amount that they have to pay. All right. So let's move to the sixth question now. It says the diagram shows the production possibility curves for two countries, X and Y. And then, okay, so we see the production possibility curve of this country X and also the production possibility curve of this country Y. And then, which statement about two countries is correct? So if you look at these options, they are talking about the opportunity costs. Yeah, mainly they are talking about the opportunity costs. So it's better to prepare a table and calculate the opportunity cost of each country for each good before we look at all these given options. Right, now look at this table that I'm going to prepare for this question number 6. So it's country X. We have two production combinations for this country X. One is here, the other one is here. So let me write production combination. Let's just label them as A and B. So at the production combination A, the country can produce 2,000 units of capital goods and how many consumer goods? 0, none. If not, at the production combination B, right, they can produce 100 units of consumer goods and then nothing from capital goods. So those are the two production combinations mentioned here. in this diagram. And we will prepare a similar table for this country Y as well. So once again, we have the production combinations A and B. So if you just focus on this PPC related to this country Y, at point A, they can produce 100 units of capital goods and nothing from consumer goods. If not, at this point B, at this point, they can produce 200 units of consumer goods and nothing from capital goods. Since these options talk about the opportunity cost of producing these goods in each country, let me just calculate the opportunity cost as well. So let me write the opportunity cost of, let's say, producing, let's say, consumer goods. The opportunity cost of producing consumer goods. So how do we make that calculation? We take delta capital goods divided by delta consumer goods. And this is the equation that we are going to apply for both these countries. So delta capital goods, the change of capital goods would be 200, and delta consumer goods, the change of consumer goods would be 100, so that the opportunity cost of producing a consumer good in country X is just 2. In the same way, let's try to calculate the opportunity cost of producing a consumer good in country Y. This has to be country Y, right? So delta capital goods would be just 100, and delta consumer goods would be the difference between these two, and that's just 200. So the value will be 0.5, right? Answer is 0.5. All right. Now, since we have these two values, we can discuss every option given here. The first one, look at this. Both countries always have identical opportunity costs. No, you can refer to the table and recognize that. In country X, the opportunity cost of producing a consumer good is just 2, but in country Y, that is just 0.5, and those two values are not identical. So based on the tables that we have developed, this statement is wrong. Second one, both countries have the same future growth prospect. See, it may or may not be true, right? It may or may not be true. The reason, if both these countries are producing at this point here, right? If they are producing at this point here, they are producing the same amount of capital goods and the same amount of consumer goods. So they may have the same future growth prospect in coming years, they can have the same future growth. If they are engaging in the production of exact same number of capital goods and consumer goods. It could be true. Direct answer it may or may not be true. So the third one, the opportunity costs are increasing in both countries. So this is the point. If the opportunity cost of producing the goods, if that is increasing in both these countries, this is not how you will get the PPC. It will take this concave shape to the origin if opportunity costs are increasing. But here, in both countries, the PPC takes this straight line, this straight shape. The reason, the opportunity cost remains constant at any point on this line. It won't change. So that this is also wrong then. It's not increasing, it remains constant. It remains constant. The opportunity cost is identical. Those are two different things. If you look at the opportunity cost of producing this consumer good in country X, that's just 2. So that is 2 at any point on this curve, right? That is 2 at any point on this curve. And the opportunity cost of producing a consumer good in country Y is 0.5, and that is 0.5 at any point on this curve. So 1 to 1, The two countries have two different values, but that whatever the value they have will remain constant at any point on the curve. So that's the meaning, right? So once you recognize that properly, once you understand that properly, you can understand that this statement is different from this statement, and both are false. Right. The fourth one, the two countries can never produce the same combination of products. No, I just told you, if they produce at the point where the two PPCs get intersect on each other, if they are producing here, they can produce, the two countries can produce the same amount of capital goods and the same amount of consumer goods without any issue. And the fifth one, country X has a higher opportunity cost than country Y in producing consumer goods. Let's look at the table. What do they say? Country X has a higher opportunity cost than country Y in producing consumer goods. So we have calculated that thing. The opportunity cost of producing this consumer good. And if you look at that value in country X, that's just 2, which is higher than the value in country Y, which is 0.5. So the answer for this question is the fifth one. Right. Now look at this question number 7. It says the table below shows the cross elasticities of demand for the product of 5 companies with respect to their price, with respect to the prices of their closest substitutes. All right. So we see in company A, the cross price elasticity of demand is +3. So company B, C, D, E, we get all the 5 companies and the values are also visible. So since all these values are positive values, yes, we can understand that they have considered substitutes, right? They have considered substitutes when calculating this CED, cross price elasticity of demand, right? So then what's the requirement of the question? That is, according to this information, the company likely to possess the greatest market power. All right. So this is the thing. So the market power of the company will be high. You just think about this thing. What will happen to the market power if there are so many substitutes? If there are so many, let's say, close substitutes. So what will happen to this market power? Think and tell me. When there are so many close substitutes, the market power will be very low because we have other competitors. And even those competitors have acquired a significant portion in the market. So the portion of the market that we have acquired is very little when we have so many other competitors. So the simplest idea behind this is, if we have so many close substitutes, our market power is low. That's the conclusion. And my next question to you is, what will happen to this value of CED if we have so many close substitutes? That value will be greater than 1. Right? The value will be greater than 1. So let me conclude the entire idea in this way. We can write, if CED is greater than 1, or simply we can say if CED is high. If CED is high, there are many close substitutes. There are many close substitutes. And then what will happen to our market power? If you look at the nature of the product that we sell, it's a very common product, right? So let me just write it. The product is common. The product is common. So if you are just selling a common product, your market power is low. Market power is low. And what's the opposite of this thing? If you understand this, you can tell me the opposite as well. So the opposite is if CED is low. If CED is low, we can say there are no close substitutes. There are no close substitutes. If so, the product that you are selling is unique. The product that you are selling is unique. If you are selling a unique product, your market power is high. So if you understand this entire thing, you can recognize the answer for the question as well. The question is, according to the information, the company likely to possess the greatest market power. Okay, it has to be the company with the lowest CED value. So out of all these given values, just select the company with the lowest CED, and that company has the highest market power. So that is this company E. So the answer for this question 7 is a fifth one. Right, now look at this question number 8. It says the total revenue of the firm will decline when. All right, the total revenue of this firm will decline when the price rises and elasticity, the supply is elastic. Second one, the price falls and the demand is elastic. I think we had a similar question. We had a similar discussion in our previous paper as well. That's this 2012. Yeah, so we have this question 2012 A-level MCQ question level. If the income elasticity of demand for good X is negative and the cross price elasticity of demand between good X and Y is negative, which of the following must be true? And that is one question. And even this 12th question, something similar to that. Assuming that the demand for bottled water is relatively price elastic, an increasing supply of bottled water will result in which one of the following? So we have discussed this. For both these questions, question number 11 and question number 12, we develop this table. So let me just take this table to this new paper 2013 MCQ. So we can have the discussion properly there. All right, now let's read this question once again. It says, the total revenue of the firm will decline when, okay, just start from the second one, price falls and demand is elastic. All right, now look at this, demand elasticity, right? That's elastic, demand is elastic, and price, what happens to the price? Price falls. Price reduces. And what's the relationship that exists between P and the producer's revenue? What's the relationship that exists between P and producer's revenue? It's a negative relationship, which means if price decreases, consumer expenditure, if not the producer's revenue, increases, right? It increases. So the question asks us to recognize the total revenue of the firm will decline. Okay, but in this case, the producer's revenue increases, so that's not the answer. The third one, price rises and demand is inelastic. All right, now look at this next one, where the demand is inelastic, right? Demand is inelastic and price rises. So what happens then? We have recognized earlier, that there is a positive relationship between the price and the producer's revenue. So what happens when price rises? Even the consumer expenditure, if not the producer's revenue, that again increases. Even this is not the answer. Right, the fourth one, price rises and demand is elastic. All right. So that's simply the opposite of the previous thing that we discussed. But once again, look at this table. It says price rises and demand is elastic. Demand is elastic and price rises. So what is the relationship that exists between price and the producer's revenue? It's a negative relationship. If so, when price increases, the producer's revenue or the consumer expenditure has to decrease. The total revenue of the firm will decline in this fourth option. When this thing happens, when price rises, if the demand is elastic, the producer's revenue will decline. So that is the answer. Question 8, fourth one is the answer. But we will look at the other options as well. In the fifth option, it says price falls and demand is unitary elastic. Okay, demand is unitary elastic and price decreases. What happens to the producer's revenue? Nothing happens. It remains the same. Right? It remains the same. Right. We skip this first one. So come back to the first one. In the first one, it says price rises and the supply is elastic. Okay. Let's assume so. We have the price and we have the quantity supplied, and on this side we have the producer's revenue, which is the multiplication of price and quantity supplied. Okay, the supply is elastic. If the supply is elastic, let's say that initially the price is 100, even the quantity supplied is also 100. And if the supply is elastic, when prices go up slightly, the quantity supplied should increase significantly. So when the price get increased just by 1 rupee, the quantity supplied get increased significantly. So let's assume that to be 200. And if you multiply this 101 with the new quantity 200, it will give us 20,200. But previously we got just 10,000. So what has happened? The price has gone up, even the producer's revenue has gone up. So even from this first option, what happens? The producer's revenue will increase. Only from the fourth one, the producer's revenue will decline. So that is the answer there. Okay, now look at this question number 9. It says, if X is an inferior good, a decrease in income will. All right. So if you draw the diagram, this is how it will look like. Right, look at this one, the quantity and the price. So you have the demand curve and you have the supply curve, right? You get the demand curve and the supply curve. And this says X is an inferior good, all right? A decrease in income will. If it is an inferior good, what normally happens is when the income decreases, the demand for those inferior goods get increased. So let's assume this to be the new demand curve. And based on the previous demand curve and the supply curve, we recognize this P2 to be the equilibrium price and Q2 to be the equilibrium quantity, right? This is the equilibrium quantity. And what happens now, as a result of decrease in this income, the demand curve gets shifted to the right side. And if you look at the new equilibrium price and the equilibrium quantity, equilibrium price has increased and the equilibrium quantity has also increased. So that's the outcome. So now you read all these given options. The first one, decreased demand. No, that's wrong because demand increases. The second one, decreased demand. Again, that is also wrong. And then the third one, increased demand. Yes, this could be a possible answer. The fourth one, increase in supply. No, it won't affect to the supply. It affects to the demand. So even this third one is also false. The fifth one, increased demand. Okay. So the answer has to be either 3, if not the fifth option. Right, the third one or the fifth option. Right, now we will read the third one. Increased demand, yes, it's true. Increased price, yes, it's true. Right, increased price. And then it says decrease quantity demanded. See what has happened to the quantity demanded, that has increased. So we think that this is not the answer. And we move to the fifth one. In the fifth one, it says increased demand, increase price. Okay, both are correct. And increase quantity demanded. So based on this diagram, yes, the fifth one is the answer. But listen to this part. Listen to this very consciously. I'm telling you, X is an inferior good. Price increases, quantity demanded increases. Once again, finally what happens? X is an inferior good, and then price increases, quantity demanded even increases. එතකොට මේක හරිද? මේක මෙහෙම වෙන්න පුළුවන්ද? එහෙම වෙන්න පුළුවන් if it's a normal, ඒ කියන්නේ if it's a normal good, then the demand curve will go to the other side. එතකොට by looking at the demand curve, we can comment on that change in the quantity demanded without any issue. But the problem, this is just an inferior good. Since this is an inferior good, මෙන්න මෙහෙම ප්‍රශ්නයක් තියෙනවා. When it comes to inferior goods, මොකද්ද තියෙන ප්‍රශ්නේ? ප්‍රශ්නේ තමයි we divide inferior goods into two types, right? We divide inferior goods into two types. On one side, we have typical inferior goods, and on the other side, we have given goods. I hope that you will remember that we have even written this. මොකක්ද ලියලා තියෙන්නේ? All the given goods are inferior goods, but all the inferior goods are not given goods. And even you should have seen this in some of the past papers as well. If you just draw a Venn diagram, if this is the circle which presents inferior goods, inside that circle you have a subset called given goods. So when they say that this good is a simply an inferior good, right? When they just say that this is an inferior good, it can be a typical inferior good or it can even be a given good. හැබැයි ඇත්තම කතාව තමයි මෙතන given good එකක් කියලා වචනේ කියන්නේ නැත්නම් we just need to assume that this has to be a typical inferior good. එතකොට what's the difference between a typical inferior good and a given good? මෙන්න මෙහෙම පොඩි වෙනසක් තියෙනවා. මොකක්ද පොඩි වෙනස? If it's a typical inferior good, yes, the income elasticity of demand will be definitely negative. The income elasticity of demand will be definitely negative. ඇයි මම එහෙම කියන්නේ? Because we have a negative relationship between the income and the demand. So that we have a negative relationship, if not a negative value for YED. Even for given goods, if you just look at the YED, the income elasticity of demand, since these given goods are inferior, again you will have a negative value. ඔන්න දැන් ඒකේ ප්‍රශ්නයක් නැහැ. නෙගටිව් වැලියු එකක් තියෙනවා. ඉතින් ඒ නිසාම මොකද වෙන්නේ? When income decreases, demand increases. When income decreases, demand increases. ඒකේ ප්‍රශ්නයක් නැහැ. හැබැයි ප්‍රශ්නේ තියෙන්නේ මෙන්න මෙතනයි. කොතනද ප්‍රශ්නේ තියෙන්නේ? If it's just a typical inferior good, you have a negative relationship between P and QD. You have a negative relationship between P and QD. Habay, if it's inferior and given, though the income elasticity is negative, you have a positive relationship between P and QD. Then mama ඔයාලගෙන් අහනවා ප්‍රශ්නයක්. If you just go back to this last part of the statement, the fifth one, මොකද්ද? එතන කියනවා price increases, quantity demanded increases. What do you see here? A positive relationship between P and QD. හැබැයි ඒක වෙන්නේ, as we discussed here, ඒක වෙන්නේ only if this inferior good is a given good. හැබැයි question එක ඔය කතාව කියන්නේ. question එක අපිට කියන්නේ that this is a given good කියලා. Inferior කියලා විතරයි නම් කියන්නේ. We just need to assume that they must be referring to a typical inferior good where we see a negative relationship between income and demand, but still there is again a negative relationship between P and QD. Again, similar to other normal goods, there is again a negative relationship between P and QD. එතර ඒක තියෙන්නේ මෙන්න මේ third option එකේ. මොකද්ද? Increase demand, increase price, and then decrease quantity demanded. එහෙනම් in this third one, when price increases, QD decreases, and that is the negative relationship that exists between P and QD. එනිසා මෙතන given කියලා වචනේ කියන්නේ නැත්නම් the most accurate answer from the given 5 options is this third one. එහෙනම් conclusion එක මෙන්න මේකයි. conclusion එක තමයි if they are referring to a given good, right? If they are referring to a given good, ඔයා simply මෙන්න මෙහෙම diagram එකක් ඇඳලා එන answer එක මොකක්ද කියලා හිතන්න නැතුව මේක normal good එකක් වුණා නම් කිසි ප්‍රශ්නයක් නැහැ. මොකද normal goods වල කොහොමද තියෙන්නේ P and QD වල negative relationship එකක් තමයි. හැබැයි මේ inferior වලට ආවට පස්සේ we can't ensure that we always have a negative relationship between P and QD. මොකද inferior given වල positive relationship එක, just inferior වල we have a negative relationship between P and QD. ඒ නිසා මේ graph එක ඇඳලා ඒක base කරගෙන මාන්ස් එක select කරන්න එපා. අර relationship එක අනිවාර්යෙන් බලන්න ඕනේ. ඒක බලන්න ඕනේ in inferior goods. එහෙනම් that's why we select this third one as the answer for the 9th question. Right. Now look at this 10th question. Suppose the market for oranges is currently in equilibrium. If the supply of oranges decreases while at the same time the demand for oranges increases, what can you say about the price and quantity of oranges in the market? All right, so you just draw the curves and try to recognize what will be the outcome in the market. So this is our original demand curve, let's say demand 1, and this is the original supply curve, so supply curve 1. So what needs to happen here? The supply should decrease and the demand should increase. Okay, so this is your new supply curve. You just draw the supply curve, and this is your increased demand curve. Demand curve gets shifted as a result of increase in the demand, and the supply curve gets shifted to the left side as a result of decrease in the supply. All right. So based on the previous curves, the previous two curves, you recognize this to be the equilibrium price and this to be the equilibrium quantity. And now, based on the new set of curves that you have constructed, you recognize this to be the equilibrium price, and here you have the equilibrium quantity. Right. And by referring to your diagram, now you just try to find the answer. And you read the first one. The first one is price and quantity both rise. See, the price has increased, even the quantity has increased. So you figure out, okay, the very first one has to be the answer, and you just select it. But wait. So what has happened here? If I tell you precisely what has happened here, the supply has decreased by a lower amount, and the demand has increased significantly. The two change in the opposite directions. One decreases, the supply decreases, and the demand increases. But if you look at the magnitude of that change, supply decreases by a small amount, whereas the demand increases by a higher amount. But what if I draw the curves in the opposite way? So what if I initially assume, wait, let's assume this is our initial demand curve and this is the initial supply curve, and supply decreases. So let me reduce the supply by this much. So supply reduces significantly now, and demand increases, but it increases slightly, right? It increases slightly. So this is the second demand curve. So based on the first set of curves, if you try to recognize the market price, see the price is P2 and the quantity is Q2. And based on the second set of curves, if you try to recognize equilibrium price and equilibrium quantity, the price is P3 and the quantity, the new quantity is Q1. And that Q1 is lower than the previous quantity Q2. See, that is the difference. ඔයාලා මේ theory හොඳට තේරුම් අරගෙන ඉන්න ඕනේ මේ ටික කරන්න නැත අර කලින් ගානේ අපි graph එකක් අඳිනවා දඩස් ගාලා ආන්සර් එක හොයාගත්ත ඊට ගැහුවා ඊට පස්සේ අපි මාස 6ක් බලන් ඉන්නවා රිසර්ච් එක. එහෙම බලන් ඉන්නක අපරාධ එතකොට. ඉතින් ඒ නිසා ඔයා theory එක හරියට දැනන් ඉන්න ඕනේ the ratio matters, the magnitude matters. එහෙනම් in this situation what can happen for sure? If supply decreases and demand rises, one thing will happen for sure. And what is that one thing? We know for sure that the price will increase. But what will happen to the quantity? That's not certain. It's uncertain. It depends on the magnitude of the change of supply and demand. So the answer is not the first one, right? The answer is not the first one. So let's read the second one. The price rises. Does that happen? Yes, the price increases. It's true. Price rises, but the change in quantity is ambiguous, which means it's uncertain. Yes, and that's the exact answer. So no point of reading the other options. This is the correct answer. But let's go through the other options. Price and quantity both fall. No, wrong. The quantity, no. Quantity rises, neither price nor quantity change. No, totally wrong. So the answer for this question 10 is the second one. Right, now look at this 11th question. Suppose the price elasticity of demand for cigarettes is less than 1. All right, so for cigarettes, we have inelastic demand. Right, so let me write inelastic demand. Inelastic demand, when an excise tax, right, when an excise tax is imposed on the cigarette production, all right, tax is imposed, it changes the price, quantity, and the consumer spending in which one of them are okay. Even to recognize the answer for that, we can just use the previous table. I hope that we have that. Yes, we have the table here. Let me take this table to discuss this question again. Now look at this one. The price elasticity of demand for cigarette is less than 1. If so, we can understand the fact that the elasticity, the price elasticity of demand is inelastic. For cigarettes, we have inelastic demand. All right, so that is one thing. And what happens when this tax is imposed in the market? The price will definitely increase. Right? If it is having an inelastic demand, when the government imposes this tax, the price will increase. So the answer will never be the first one or the second one. So we can simply cut those two. Okay, see, the price will increase. And what will happen to the quantity? What will happen to the quantity? Now, for example, let's assume that the initial price is 100, even the quantity demanded is 100. And as the result of this tax, let's say that the government is imposing a tax of rupees 20. So due to the tax, the price increases, right? The price increases. But the problem, since it's having this inelastic demand, the demand drops. It's true, the demand decreases, but by a very insignificant amount. Even if the price increases by 20%, the demand drops just by 1%. Right, now let's calculate and see the consumer spending. So initially the consumer spending is just 10,000 and the new consumer spending is 120 multiplied by 99. That will be 11,880. See what has happened. The price has increased. Right, the price has increased, the quantity has decreased, but however the consumer spending has increased. If the demand is inelastic, right, we have a positive relationship between price and the producer's revenue. So when price increases, the consumer expenditure also increases. In on a table like barrel, you can recognize the answer. So for this question 11, fourth one is the answer. Right. Now look at this question number 12. It says, suppose the government sends each parent a coupon that can be used to subsidize the cost of sending each child to daycare. All right. So what would you expect to occur in the market for daycare services? All right. So in the daycare services market, let's assume the current equilibrium is here. Right? Current equilibrium is here. So the current price is P2, the current quantity is Q2. This is the quantity axis, this is the price axis. You get the supply curve, you get the demand curve. And what is going to happen? The government is providing a subsidy for the parents. This subsidy is offered to the consumers. When a subsidy is offered to the consumer get encouraged to consume whatever that product, so that the demand should increase, right? Demand should increase. So this is our new demand curve and this is a previous demand curve. So when demand increases, what happens in the market? See, the price also get increased to P3, from P2 to P3. Even the quantity increases from Q2 to Q3. The demand for daycare falls. No, that's wrong. The demand for daycare rises. Yes. Increasing the price here. The price also increases. And then the answer has to be the second one for this question number 12. The supply of daycare rises. No, this time this subsidy is offered to the parents. If not, the subsidy is offered to the consumers. Nothing happens to the supply curve. The fourth one, the supply of daycare falls. Again, nothing happens to the supply as the subsidy is offered to the consumers. Then the fifth one, a permanent shortage of daycare services would exist. So this is what will happen in the market. Right. And our answer is 2. That's clear. So let's move to the 13th one. Right. In the 13th one, it says, what is necessary for consumer surplus to be 0? All right. So this is just a simple question. So just assume you get the demand curve and the supply curve, right? You get the demand curve and the supply curve. So this region, මම ඒක ඔයාලා හැමෝටම කියන්නම් හොඳට අහගන්න මේක මතක තියාගන්න මම මේ කියන එක වෙනස් වෙන්නේ නැහැ මේක ඕන තරකට වැලිඩ් මොකද්ද the region below the demand curve above the market price up to the quantity traded in the market is the consumer's surplus. And if you look at the producer's surplus, we don't need that for this question, but I'm just telling you මේක ලියා ගන්න මේක මතක තියාගන්න the region above the initial supply curve and below the price received by the producer and up to the quantity traded in the market. The region that satisfies all those 3 conditions is the region that shows the producer's surplus. So in this diagram, in red color, you see the producer's surplus and in blue color, you see the consumer surplus. Then what is necessary for the consumer surplus to be 0? ඒක හරිම ලේසි. ඔයා මේ supply curve එක එක්කෝ supply curve නේ ඔයා මේ demand curve එක අරගෙන මෙන්න මෙහෙම if you just rotate this anti-clockwise, what happens to that consumer surplus? See, when I rotate this, what happens to the consumer surplus? That blue color region slightly reduces, and when the demand curve becomes parallel to the quantity axis, right? When the demand curve becomes parallel to the quantity axis, the consumer surplus becomes 0. If I just show you this using another diagram, if the diagram looks like this is the weight, this is the supply curve, and if this is your demand curve, දැන් මොකද වෙන්නේ මේකේ තියෙන්නේ අර මම දෙවණියට කියපු region එක විතරයි මොකද්ද in this diagram you see the region above the initial supply curve below the price received by the producer up to the quantity traded in the market, which means this time you only see the producer's surplus in this diagram and you don't see the consumer surplus. The reason it's zero. Now, how do we recognize this shape of the demand curve? We recognize this as a perfectly elastic demand. When the demand becomes perfectly elastic, the consumer surplus becomes zero. Right. Let's read the given options and try to recognize the correct option. Demand is perfectly price elastic. Yes, that is the answer. But I will go through the other points as well. So let's see the second one. Demand is perfectly price inelastic. All right. So let me just draw another diagram where we have a perfectly inelastic demand curve. Right. So this is the supply curve. And this time the demand curve is this. Right. This is the demand curve. right දැන් ඔයා මේක දිහා බලුමත් සමහරට ඔයාට හිතෙනවා ඇති සමහර කලින් රීජන් එකමනේ දකින්නේ මේකෙත් කියලා. හැබැයි මේකේ ඇත්ත කතාව මෙන්න මේකයි. ඔයාලට මතකද when it comes to this question 5, right? In this question 5 I just told you that this is what the consumer is willing to pay. And this is what the consumer really pays, right? He is willing to pay a price of this much and he really pays a price of this much thanks to this market equilibrium. So the difference between the two prices, the price that he is willing to pay and the price that he actually pays, the difference between those two we recognize as the consumer surplus, but that is the consumer surplus for this unit, the 25th unit. Clear? If you remember that, now come to this new question again and imagine that here you get this 25th unit. And if I ask a question, what's the price that this consumer is willing to pay for this 25th unit? It's somewhere here, that's infinity. We don't even see that because since the product is having a perfectly inelastic demand, right? Since the product is having a perfectly inelastic demand, doesn't matter what the price is. The consumer is ready to pay whatever the price to purchase that required quantity. So this price could be infinity then. Then this infinity is the price that the consumer is willing to pay. And this is the price that he really pays thanks to this market equilibrium. So this difference between infinity and the price that he really pays is the consumer surplus. So what happens when the demand becomes perfectly inelastic, the consumer surplus becomes infinity, right? It becomes infinity, not zero. So the total opposite of what we really discuss here. We wanted this consumer surplus to become zero, but in real, when the demand is perfectly price inelastic, it becomes infinity. So that this is not the answer. Right, the third one, supply is perfectly price elastic. All right, we will do this and say supply is perfectly price elastic. Okay, then we have a typical demand curve. And let's say the supply is, if it is inelastic, the supply curve should start from the price. Sorry, it should start from the quantity axis, right? This should start from the quantity axis. If so, then this region is the consumer surplus, and then this region we recognize as a producer surplus. So consumer surplus is not zero. Hope you can understand that. The next one, supply is perfectly price inelastic. If supply is perfectly price inelastic, let's see what can happen. The quantity axis, the price axis, we have a typical demand curve, and this time the supply is perfectly price inelastic. If so, this is the shape of the supply curve, right? This is the shape of the supply curve. So once again, for this 25th quantity, this is what the consumer is willing to pay, and this is the amount that he really pays. So this difference, if not this total region covered by this triangle, we recognize as the consumer surplus, and that is not zero. And that's why we don't take this as the answer. The fifth one, price elasticity of demand is relatively greater than the price elasticity of supply. Okay, so for that, අපි අඳිමු මෙහෙම එකක්. Let's draw a supply curve which is inelastic and a demand curve which is really elastic. So what happens to the shape of the demand curve if the demand is elastic? Then මෙහෙම ඇන්දොත් ඒක perfectly elastic demand curve එකක්. හැබැයි slope එක චුට්ටක් අඩුවෙන් flatම තමයි, හැබැයි flat නෙමෙයි. එහෙම ඇන්දොත් මොකද වෙන්නේ? You get this triangle, right? You get this triangle, this smaller region to be the consumer surplus. The consumer surplus is visible, which means the consumer surplus is not zero, and that's why you can't take this one to be the answer. So the answer for this question number 13 is the first one. Right, now look at this 14th question. There will be a simultaneous increase in both price and the quantity traded in the market for a normal good due to which one of the following? All right, so let's read the given options. The first one, the removal of effective maximum price on the good, which means we need to assume that right now the government has imposed an effective maximum price and they are going to remove it. So let's see the situation in the market. The quantity axis, and then you get the price axis. Here you recognize this to be the demand curve. You get the supply curve here. So based on the demand and supply, the equilibrium price will be here and the equilibrium quantity will be here. But you need to understand one thing, that these are not the market price and the market quantities. This is the equilibrium price and the equilibrium quantity. So what has happened in the market now, the government has imposed an effective maximum price. So when this effective maximum price is imposed, the market price decreases from EP to P1 and the quantity supplied get decreases from EQ to Q1 and the quantity demanded get increased from EQ to Q2. So if I ask you to tell me the market price and the quantity traded in the market right now, what's the market price? Market price is this price P1 and the quantity traded in the market is just this Q1 quantity. Why do we recognize them in this way? When this effective maximum price is imposed, that will be definitely a price lower than the equilibrium price. So that is the market price. And when the effective maximum price is imposed, the quantity demanded increases to Q2, but the producers are supplying only this amount of Q1, so that Q1 is the quantity that is traded in the market right now. And what's going to happen in this market now? The government is going to remove this effective maximum price. So when this line or when this maximum price is removed, what will happen in the market? The market price will once again be same as the equilibrium price, which means the market price will increase. And that's one thing that we need to happen. Market price should increase. And what happens then? The quantity that is traded in the market will increase from Q1 to EQ. So both get increased. I mean, price and the quantity traded both get increased after removing the effective maximum price on the good. So that's what they ask us to recognize. From which one of the following actions the market price and the quantity will increase? So the answer is the first one, right? Question 14 answers the first one. But we will go through the other options as well. The second one says technological progress in the production of that good. Okay, due to the technological progress, what will happen in the market? Look at this new one now. If this is the demand and if this is the supply, when the technological progress happens, right? When the technological progress happens, the supply curve gets shifted to the right side, which means simply the supply increases. Now what happened in the market? Previously, we can recognize this to be the market price and this to be the equilibrium quantity. But when the technology get advanced, the price reduces to P1 and the quantity increases to Q2, and that's not what we look for. We need both price and the quantity to increase, but from this particular action, the price reduces even if the quantity increases. So that is not the answer there. The third one, the imposition of tax on the good. Okay, so let's assume this to be a unit tax which is imposed on the suppliers. Then what will happen in the market? The opposite of this will happen in the market. So let me show you the outcome in the market. Let's recognize this to be the current supply curve, and the government is going to impose a unit tax on this product. So after imposing the unit tax, the supply curve gets shifted to the left side, right? So in the initial situation, we recognize this to be the equilibrium price and this to be the equilibrium quantity. But what happened now after imposing the tax, the price increases from, let's say, EP to P2. But what happens to the quantity? Quantity drops from EQ to Q1, which is once again not what we look for. So this is not the answer there. And look at the fourth one. The fourth one says granting of a subsidy to the producers of the good. So the same outcome as to what we discussed in the second one. So when technological progress happens, the supply get increased. Even if the government is providing a subsidy to the producers, again the supply increases so that the supply curve gets shifted to the left side. So the outcome in the market will be same as what we discussed in second option. So then it is not the answer again. The fifth one, decrease in the price of a substitute for this product. So what happens when the price of a substitute get decreased? That influences on the demand curve of the product. So let's discuss it in this way. You get the quantity, you get the price. This is the demand curve and this is the supply curve. So when the price of a substitute decreases, consumers move from this considering good to that substitute, so that the demand of this good decreases. When demand decreases, the demand curve gets shifted to the left side. So let's assume based on the previous market conditions, this to be the equilibrium price and this to be the equilibrium quantity. So after this demand decreases, see what happens. Both market price and the market quantity get decreased. And that's the opposite, the exact opposite of what we look for. So this is also not the answer. The answer for this question 14 is the first one. Right. Look at the 15th question. In the 15th one, when the marginal product of labor is equal to the average product of labor. Okay. So if you remember the curves related to this marginal product and the average product, this is how they change. Let's assume this to be the marginal product. And if so, this will be the shape of the average product curve. So on this side, we get the quantity and then we get the average product and the marginal product on the y-axis. All right, so we will read the given options. When the marginal product of labor is equal to the average product of labor, which means they are referring to this particular point, right? They are referring to this point. So when the two become equal, the first one, marginal product of labor, is at its maximum. Now the marginal product reaches maximum before the maximum point of average product. So this is where we see the maximum amount of marginal product of labor. So this given option is wrong because that doesn't happen at this point. Right, so that's wrong. The second one, marginal cost of production is at its minimum. Once again, marginal cost of production is at its minimum. Okay, here we have drawn only the product curves, not the cost curves. So we will once again draw the product curves in order to analyze this given statement. Right. So we have discussed this in our theory classes. When the marginal product changes in this way, the upside down reflection of that curve is the marginal cost curve, right? That is the marginal cost curve. So the upside down reflection. So let's assume this to be the marginal cost curve. And the upside down reflection of this average product curve is the average variable cost curve. So what happens when these two become equal to each other, right? When these two become equal to each other, from the other side, what happens? Even the marginal cost become equal to the average variable cost. Now, keeping this idea in mind, we will go through this second option. Marginal cost of production is at its minimum. No, the marginal cost becomes minimum when the average product becomes minimum, not at this given point. So that is also not the answer there. The third one, marginal cost is equal to the minimum average variable cost, which means at this point, when these two become equal, MP and AP become equal. See, as we discussed earlier, what will happen in this market when AP becomes equal to MP? What happens in this market? Even MC becomes equal to average variable cost. And that's what they have mentioned in the third option. Marginal cost is equal to minimum average variable cost. See the minimum average. See, this is the shape of the average variable cost curve. So this MC curve, we have discussed these things in the theory classes. This MC curve goes through the minimum point of ABC. If so, this has to be the minimum ABC, right? At that point, you should receive the minimum value for ABC. Marginal cost is equal to the minimum average variable cost. 100% correct. Right. Look at the fourth one. Average total cost is at its minimum. No, the average total cost curve will be somewhere here, right? It will take this shape, average total cost, but its minimum point will lie somewhere here, not at this given point, right? The fifth one, total product of labor is at its maximum. See, at this point, when AP equals MP, if you just draw the TP curve, right? If you draw the TP curve, it will look like this. TP curve has how many different regions? Initially, it increases at an increasing rate, and then it starts to increase at a decreasing rate. When MP reaches 0, the TP curve reaches its maximum, and when MP takes negative values, the TP curve decreases. So this is the shape of the TP curve, right? This has to be slightly. So this is increasing at an increasing rate, and this is increasing at a decreasing rate, reaches maximum and then declines, right? So what do they say at this point? What happens in this market when the two become equal? What happens? The TP curve increases at a decreasing rate. So is that what they have mentioned here? Total product of labor is at no. It becomes its maximum point when MP reaches 0, right? When MP reaches 0, TP reaches maximum. So that's not what happens here. Even this is wrong then. Even this is wrong then. So the answer for this question 15 is the third one. Look at this 16th question. To increase its labor force from 100 to 101 workers. Okay, the labor inputs, right? Labor inputs. They are trying to increase this labor input from 100 to 101. And when trying to do so, what will happen? A firm has to increase its daily wage rate from 600 to 650. So the first thing, okay, I'll just do it in this, I'll just go with the flow. So the question has given us the wage. So wage rate, actually, right? This is the wage rate, and you don't think about this much. So you just think that the daily wage rate increases from 600 to 650. Under this situation, the marginal cost of the labor per day. The meaning of this term marginal. So what's the meaning of the term marginal? One more. When they increase the labor from one more unit, when they increase it by one more unit, the wage rate increases by 50. And you are in the exam and you see that 50. You just select that to be the answer. This is the wage rate, which means that is the average wage. This is not the total cost, the total wage. So in this example, if you try to recognize the total wage paid to all these employees in the factory in the two situations, in the, let's say, total wage, right? So in the first scenario, it's just 600 and another two zeros, so 60,000. And in the second scenario, you just multiply 101 with 650, so that will be 65,650. 65,650. Right. See, I hope that you will remember when calculating this marginal cost, the equation that you apply is change in total cost divided by the change in quantity. So the change in total cost is given to us as 5,650, right? 5,650, and that is divided by the change in quantity, which is 1 in this case, so that the marginal cost of labor will be 5,650. So that the answer is the third one, not the first one. Right. So that's about the 16. Now look at this 17th one. In the 17th question, give me 1 second. Right. In the 17th question, they say an economist calculates that a firm has incurred the following production cost over the course of a year, right? And then by giving all these values, what do they ask us to calculate? By how much does total cost as defined by an economist exceed the total cost as defined by an accountant? Okay, so the question is simply asking for the difference between accounting cost and the economic cost. So if I just write this equation, accounting cost is equal to just this, direct cost. But in economics, when you recognize this cost, economic cost, that is the total of direct cost and indirect cost. So look at the difference between this accounting cost and the economic cost. This part is common to both these equations, but this economic cost exceeds the accounting cost by the amount of indirect cost, right? By the amount of indirect cost. And in this question, that's what they ask us to calculate. You don't need to calculate this, both accounting cost and economic cost. If you know the theory, you can understand the fact that economic cost exceeds the accounting cost by the amount of indirect cost. You need to simply calculate the amount of indirect cost in this. What's the difference between this indirect cost and the direct cost? So what's the difference? Wait, I'll show you the note related to that. Right, look at this note. This is about explicit cost, if not direct cost. It says actual cash payments for purchased or rented resources from factor market. for a chosen production activity is explicit cost or direct cost. So that is the definition. And you see some examples for such costs. And implicit cost, if not indirect cost. So what's the given definition? The opportunity cost of resources owned by the firm that are sacrificed for a chosen production activity is implicit cost or indirect cost. And for the indirect cost, I have given these examples. Look at the 4 examples. The first one is foregone interest income. The second one is, remember, the first one is about the foregone interest income, which means the owner uses his own financial capital so that he sacrifices the interest that he could have earned by depositing that money in a bank account. So that is what we recognize as the foregone interest income. නැතු අපි bank එකෙන් loan එකක් ගත්තම ඒ loan එකට ගෙවන interest එක that's something that we receive from the factor market. එතකොට ඒක ඇවිල්ලා that is something that we take from outside. එතකොට ඒක that is not a part of indirect cost and that will be a part of direct cost. And the second component in indirect cost is opportunity cost of own labor, and the third component is about normal profit, and the fourth one is about economic depreciation. So once again, this is the depreciation of capital assets owned by the owner, right? Not the depreciation of capital assets that you have taken from the outside market. Right, now keeping all these things in mind, come back to this question. So wages and salaries is something direct cost. So we don't need to consider that when calculating indirect cost. Opportunity cost of owner's time, see that now. That is a component of our indirect cost. So let me just take that value here. The first value that we found is 40. Opportunity cost of own labor. And then cost of materials is direct. No need to consider that. Rent is again direct. Marketing fees also direct. Interest on bank loans, I told you, it's not the foregone interest income. It's about the interest that you pay for the loans that you obtain from the banks, which is a part of direct cost. And then the last one says interest foregone on finance provided by owner, which is the foregone interest income. So even that 15 must be considered when calculating indirect cost. So the total of these two you receive as 55, and that's the indirect cost, and that's the amount from which the economic cost will exceed accounting cost. And an answer for this is 55,000. The reason all the values are in thousands. So for question 17, second one is the answer. Right. The 18th question. Sorry, firm A reduces its workers from 250 to 200. So they reduce the amount of workers. And as a result, its output decreases from 5,000 to 4,800 units, right? Per day. Firm B increases its workers from 800 to 1,000. And as a result, its output increases from 2,000 to 2,200 units per day. Okay, so what the requirement? The requirement is what happens to labor productivity of the workers in the two firms. All right, okay. So this is how we calculate this productivity. We write the equation productivity equals simply output divided by inputs. Now, in this case, it's about the inputs of labor. And we have two situations and we have two firms. So let me first write firm A, situation 1, and then situation 2. Right? Situation 1, then we have situation 2. Also, we have this firm B, again, they have this situation 1 and situation 2. All right. So let me just take this one inside this thing. All right. So in the first situation, their output, this is the general equation that we use in both calculations. This is the equation. So what happens in the first situation? Output decreases from 5,000 to 4,800 units. So let me just write that value in this cell. 5,000, it decreases in situation 2, it decreases to 4,800. And the inputs, the amount of workers decreases from 250 to 200. So inputs in the first situation, input will be 250, but in the second situation, that will be 200. And with regard to firm B, their output increases from 2000 to 2200. So let me write in the first place, in the first case, it is just 2000, but in the second case, it's 2200. And the amount of inputs, if you look at that value, that is in the first case 800, but later on it get increased to 1000. So it's 800 divided by 1000. Now based on these values, you can calculate the productivity in both situations for each firm, right? So the first one is 5000 divided by 250, and that gives us this value 20. And in the second situation, 4800 divided by 200, and that gives us this value 24. So you can understand what has happened to the labor productivity in firm A. The productivity has increased. And for firm B, if you calculate the productivity in the second situation, that's 2000 divided by 800, that will be just 2.5. And then 2200 you divide by 1000, that will be just 2.2. So what has happened? The productivity of labor in firm B, that has decreased. So labor productivity of firm A, it increases, it rises. So one of these must be the answers. And the labor productivity of firm B should decrease. So it falls. So the answer for this question 18 is the second one. Hope you can understand that. No need to discuss the other points. The reason, simply by looking at the table, you can understand what is correct and what is wrong. Right. Now come to this question number 19. In question 19, it says, an industry consists of large number of firms. Large number of firms, all of which produce an identical product. Okay, what could explain why demand curve facing each individual firm is downward sloping? Okay, now by looking at these qualities of this given market structure, we can understand that in the first part, they are referring to a perfectly competitive market structure. The reason, if there are large number of firms producing the identical product, theoretically it has to be a perfect competitive market structure. It has to be a perfect competitive market structure. But what happens if it's a perfectly competitive market structure? The firm becomes a price taker and they can sell any quantity that they produce at the decided price in the market, so that each individual firm, right? Each individual firm will face a perfectly elastic demand curve, right? Each individual firm will face a perfectly elastic demand curve. If not, the demand curve faced by each individual firm will be something parallel to the quantity axis, right? That will be something parallel to the quantity axis. But in the second part of this question, they say that the demand curve facing each firm is downward sloping. So this is not what we expected to happen in the perfect competitive market structure. For some reason, right? For some reason, the demand curve is sloping downwards. So it is a typical demand curve. එහෙනම් ඔයාලට දැන් තේරෙන්න ඕනි මේකට අහන්නේ මොකද්ද එතකොට? what could explain why the demand curve facing each. Okay. Then a reason that you can use to prove that this firm is not operating in the perfectly competitive market structure. If the firm is operating in a perfectly competitive market structure, it should have a demand curve which takes this shape. For some reason, if this firm is not operating in a perfectly competitive market structure, they will face this typical demand curve. Then the options one will describe, four of the given options will describe the features of a perfectly competitive market structure. No one you just need to recognize that. Okay, the first one, all firms act as a price takers, so that is a quality in the perfectly competitive market structure, and as a result of this, as I mentioned earlier, this will be the shape of the demand curve. Right. The second one, freedom of exit and entry, is once again a main feature that we have in the perfectly competitive market structure. And perfect factor mobility of resources, perfect factor mobility is once again another quality, a characteristic in the perfectly competitive market structure. A limit on the amount of consumers have available to spend. A limit on, again, the purchasing power of the consumers get limited, right? Purchasing power is limited. Purchasing power is limited. Okay, we'll keep this for a second. And the fifth one says imperfect knowledge about the market on the part of consumers. See that now, having perfect information is the quality of the perfectly competitive market structure. But for some reason, if imperfect information is available, the consumers are really unaware about the product quality, the prices in other markets. They may buy a higher quantity at lower price, or maybe they will buy a lower quantity at higher price, not knowing that this same product is available in a different business firm, in a different market, right? Not knowing that, they will act in that way. And this fifth quality will lead to this demand curve. But what's the meaning of this fourth one? A limit on the amount of consumers have available to spend. So the purchasing power is limited. If the purchasing power is limited, or the another, it influences on the position of the demand curve, not the shape of the demand curve. Now, for example, if the purchasing power get increased, if consumers' income increases, then the position of the demand curve will change this way. But the shape will still be the same. If their purchasing power get limited for some reason, if that reduces for some reason, again the position of the demand curve will change, but the shape will still remain the same. Hence, this purchasing power will not influence on the shape of the demand curve, it will influence on the position of the demand curve. And our answer for this 19th question is the fifth one. Right, now look at the 20th question. A perfectly competitive firm is producing 200 bags of rice per week, which it sells at rupees 250 per bag. Okay, so if it's a perfectly competitive firm, we have discussed these things in our previous paper discussions. The price and the marginal revenue and the average revenue, they all are equal, so that you can consider these values to be, the price, the marginal revenue, the average revenue to be 250. And they produce a quantity of 200, and then they give us these data as well. Total fixed cost 20,000, total variable cost 40,000, and the marginal cost is also 250. Right. And then by giving all this information, they ask, in the short run, what should the firm do to maximize profits or minimize its losses? All right. So we can decide on that by looking at the marginal revenue and the marginal cost, right? By looking at the marginal revenue and the marginal cost. So as per the given information, even the marginal cost is rupees 250. And we earlier recognized that the marginal revenue of the firm is also 250, which means what has happened here, the marginal cost become equal to the marginal revenue, and this is the optimum condition that gets satisfied in the equilibrium of a firm operating in the perfectly competitive market structure. Their profits will be maximized, right? Their profit will be maximized when MC becomes equal to MR and MC is increasing. Let's assume so that MC is increasing. If it is increasing, then MC becomes, at this point where MC becomes equal to MR, at this level of quantity, they have already maximized their profit. So what they need to do, they just need to continue producing this exact same amount of output without changing it. So if they increase it, it will decrease their total profit. Even if they reduce it, the quantity, once again, it will reduce their total profit. And so they just need to continue what they are doing. So seize the product, no. Increase its output, no. Decrease the output, no. Lower its price, no. Maintain its output at present level. See, the fifth one is the option D. Right. Now look at this question number 21. Which one of the following would not affect the size of real GDP? Right. The size of real GDP means you just need to find the component which will not be included when calculating GDP. If it is not considered, then it will not affect the magnitude of the GDP. Right. Consumer purchases a new car for personal use. If it's a new car, it's a value addition to the economy. So GDP is simply the total of all the value additions in the economy. So when one consumer purchases a new car, the GDP will increase. Right. The second one, the government purchases a new bus, a new car, make a new bus, monotagatta, that is a value addition in the economy, and it will increase GDP. Third one, a consumer purchases a haircut from a hairdresser. Okay, once again, this is a service, so it's a value addition. So when that happens, GDP will increase. An investor purchases a rare Renaissance painting at an auction. This is the purchase of a used good. So if it's a purchase of used good, we do not consider such transactions when calculating GDP. Right? So this is the answer for this question number 21. The reason we don't consider this purchase when calculating GDP, as it's a purchase of used good. Right. Then the answer is the fourth one, but we will go through the fifth one as well. A firm purchases a new power generator for its factory. Once again, it's a new power generator, so it adds value to the economy. And an answer for this question 21 is the fourth one. Right. Now look at this 22. Suppose that autonomous consumption is rupees 400. Okay. Autonomous consumption, how do we denote that? We just use this letter A to denote that value. So it's 400. And that the marginal propensity to consume, MPC, is 0.8. If not, Based on that, we can even calculate MPS to be 0.2. If disposable income increases by rupees 1200, okay. If delta YD is 1200, if it changes by 1200, consumer spending will increase by, okay, this is very much simple. So to find the consumer spending, you just need to multiply that whatever the change that happens in the disposable income by the marginal propensity to consume. What's the meaning of this marginal propensity to consume? The meaning is if the consumer, if the disposable income of this consumer increases by 1 rupee, he will put 80 cents for consumption so that the remaining 20 will be allocated for savings. If his disposable income increases by 1200, by how much he will increase the consumption. 1200 we simply multiply by 0.8 and the answer will be 960, right? The answer is 960. So that is by how much his consumption spending will increase. So answer for this question 22 is the fourth one. Right, 23, it says in a closed economy with only lump sum taxation, so one-time taxation, if the marginal propensity to save is equal to 0.25, which means MPS is 0.25, rupee 80 billion increase in government purchases, which means the government purchases get increased by 80 billion, could cause a maximum increase in output. Okay, so this is something that we have discussed in our previous papers as well. So if you need to recognize the change of the equilibrium income or maybe the change of equilibrium output as a result of changing one of the autonomous expenditure, you just need to multiply that change in autonomous expenditure by the multiplier, autonomous expenditure multiplier. So how do we find this autonomous expenditure multiplier? So let me just calculate it here. We write K equals 1 over, generally we just write it as 1 minus MPC. If not, it is simply equal to MPS. So 1 over 0.25 will be 4. Then we write 4 into the change in autonomous government expenditure will be 80. Then this will be 320. So the output will increase by 320 billion. So answer for this question 23 is the fifth option. Right, 24. Look at this question 24. In a closed economy with no government, the consumption function is given to us. If there's no government, this is a simple economy. So both Y and YD denote the same thing. So the consumption function is given to us as 30 plus 0.7 into Y. And okay, the equilibrium level of income is rupees 300 million. Okay, equilibrium level of income is 300 million, which is Y. Y is given to us as 300 million. What is the level of investment in this economy? All right. So this is somewhat very easy. So what happens at the equilibrium? Injections become equal to the withdrawals in the economy. And if it's a simple economy, the only injection that must be here in this economy is investment, and the only withdrawal in this economy must be savings, right? It must be savings. So the requirement is to find this I. So how do we find I? Since we have made this I equal to S, based on this consumption function, we can very easily develop the savings function. And let me just make this I equal to that savings function. So what's the function of savings? That will be, if consumption function goes as 30 plus 0.7 into Y, the savings function goes as minus 30 plus 0.3 into Y. And we all know that Y is given to us as 300. So I is equal to minus 30 plus 0.3 into 300, which will be 90. So that the final answer is 60. So investment in the economy is 60 million. So the answer for this question 24 is the first one. Right, now look at this question 25. The diagram below shows the savings and investment curves of a closed economy with no government. Once again, it's a simple economy. And then the potential level of output is YP. Okay, the potential level of output, which means the full equilibrium, full employment level of output is YP. Therefore, the gap between actual and potential output can be measured by the distance. All right. So by giving us the potential level of output, they ask us to identify which one of these represent the gap between actual and the potential output. All right. The gap between actual and potential output. Okay. So as we discussed earlier, at the equilibrium, if it's a simple economy, I will be equal to S, right? So this is the investments curve, and this is the curve which represents the savings. So at this point G, what happens? I becomes equal to S. So what does that mean? This is their, right? This is their actual output. YP, as I mentioned earlier, YP is the full employment level of output, but this Y1 is the actual output. So the difference between Y1 and YP shows us the gap between actual and potential output. But මේ Y1 කියන එක මම දාපු එකක් නේ. එතකොට එයාලගේ graph එකේ Y1 වෙනුවට තියෙන්නේ G. එතන YP වෙනුවට අපිට ගන්න පුළුවන් H. So the gap between G and H, right? The gap between G and H shows the gap between actual and potential output of this economy. Hence, this second one becomes the answer for this question 25.